Hello everyone, there is a lot to talk about in today's video. We're going to talk about the impending death cross that's about to happen on the Russell 2000. We're about to talk about important levels of resistance on the SPY that we're currently touching from back in July of 2021. So we're going to talk about everything. We're going to talk about the S&P 500, the NASDAQ, the Russell, the dollar, the bonds, the VIX, the yields. And of course, we're going to continue looking at the large tech stocks. We're also going to take a look at the McClellan oscillators and what those are showing now, how they're either flipping bullish or how much room there is left to go. All right, so without further ado, let's get started with the video. All right, so first of all, we have very, very important news coming out tomorrow morning. We have CPI data coming out. So if CPI data comes out less than forecast, then that's going to be very bullish for stocks. Expect the Russell to do well, consumer cyclicals and everything to do really, really well. This is very important news. So it's hard to really gauge which direction the market's going to go overnight. But the way that the market has been responding thus far, there's a lot of buyers. So it feels like people are expecting this news to not affect as much because there are a lot of aggressive bulls, even at these levels. It's pretty crazy. So I don't know how, I don't know how, even if CPI data was bearish, I would be very, very surprised if we reverse here and we end up breaking below 420. And it's never, I think we end up, I personally think the SPY currently it's at 437. We should break above 440, regardless of how bearish CPI data is going to be. All right, so that's my thought process. All eyes tomorrow morning at 8:30 a.m. on CPI. All right, so next, let's take a look at the Fed watch tool. So the Fed is anticipating one more rate hike before the end of the year. And if we do end up getting high CPI data numbers, then the chance of having a rate hike is going to increase. So for the November meeting, we have a 91.5% chance so far that there will be no change. And the December meeting, there's a 72% chance that there will be no change. So what I'm saying is that once we get bad CPI data, the chance of an increase or a rate hike will rise. And if this rises, then obviously it's not going to be that bullish for stocks. So we're currently looking at the Fed watch tool. Probability wise, they're saying that there isn't going to be a change, which is generally pretty bullish for the market. Next, we have to take a look at seasonality, because seasonality was the one thing people were expecting that this week was going to be very, very bearish. And it's because of seasonality. People were expecting that we were going to drop below 420, hit 415, 416 again. But you can't always rely on seasonality perfectly, because when there's an aggressive amount of buyers, everything just goes out the window. And what we saw recently was an aggressive, exuberant, just irrational amount of buying power. So when that happens, you can't expect dips to occur in the normal frequency. And that just goes to show that this week we were, according to seasonality, supposed to be a bit bearish and make new lows, but that did not occur. We ended up making new highs instead. And just as a refresher, once more, October, there's a 65% chance that we end up being green. In November, there's a 75% chance that we end up being green. And then December, there's a 70% chance. So these 3 months, we generally just skyrocket. So, yeah, we're seeing a lot of buyers. We're seeing a lot of aggressive buyers in large tech. But now, things are starting to get closer to levels of resistance. And the large tech stocks are starting to get a little bit overextended. So now let's go ahead and take a look at the rest of the market. Let's take a look at the dollar and the VIX and the yields, and then we can take a look at all the other fun stuff. All right, so this is a chart of the dollar, and we are starting to just show a lot of weakness now. So we're getting close to a level of support. It's really, really tough to start being bearish on the dollar. We have like a complete just drop from this resistance level here. And it's important to look at the dollar, it's important to look at the VIX, and it's important to look at the yields because they all have an inverse relationship to the market. So the dollar, when it's rising, is generally bullish for the market. Okay. And right now you can see that we broke below this level of support, but this is a doji candle right close to a level of support below as well. So it's starting to get really, really difficult to be extremely, extremely bearish on the dollar. I mean, at this point, there should be a little bit of a bounce on the dollar. I'd be surprised if there isn't. I would genuinely be surprised if we just continue falling. But I don't mind because I'm in calls. So, but pragmatically, there should be a bounce. That's the way proper market structure would dictate the movement of the dollar. There should be a bit of a bounce. But if there isn't, it is what it is. But that's what it's currently showing me. We have a level of support right here. And this is somewhat of a reversal candle. So let's see if there's some buyers that can step in on the dollar. If not, then that's tough. Next, let's take a look at the VIX. So the VIX is also important because it has an inverse relationship to the market. So if the VIX is rising, then the overall market is going to be falling. So right now we see the VIX is showing a lot of weakness. Clearly, these were all really, really bearish setups. These were not bullish setups at all. All right. And the VIX is getting, like I was saying, the VIX below $17 is known to be very, very bullish for the markets. Okay. So we're comfortably trading below 17. And now we're getting close to 1550. So 1550 is another really, really important level of support. And we just have to see if the VIX can basically hold this level of support on the VIX. That's really it. This is not a bullish setup on the VIX. If the VIX was a stock, now is not the time to start going long on the VIX. But what is interesting is that the dollar and the VIX are starting to show like really, really aggressive weakness. And when stocks start to show aggressive weakness, that weakness generally does not sustain itself. So it's going to be interesting to see what happens here, but we're seeing some crazy aggressive buyers out of equities. We're seeing a lot of put sellers out of equities. And when people sell puts, they're basically creating a base where they don't want the price to fall lower. So we're seeing a lot of put sellers. The last rally that we had, we saw aggressive put sellers at 170 on Apple. So that's currently what's going on the overall market as a whole right now. So there's a lot of put sellers. Really, really just aggressive buyers on the IWM, Amazon, Tesla. So it's going to be interesting. So this weakness can continue, but generally it doesn't. And the weakness on the dollar, it could continue, but generally we should see a bit of a bounce. So let's see. But what is very, very interesting is the yields. So the yields made another huge leg down. So this is getting to this paints a much better picture of what I'm trying to explain. So the yields are important to look at because they have an inverse relationship to the market. Okay. And so once again, when the yields are showing weakness, then that's generally good for the market. Weakness like this in stocks doesn't really sustain itself. We should get a bit of a bounce soon. If we make another leg without bouncing a bit first, if we just fall, make another leg, it's gonna be really, really tough to just be blindingly bullish on the market. Because look, what I'm saying is if we end up making another low on the yields, right? This is the 10-year yield. If we make another low without first bouncing to at least 50% of this candle here, I would be very, very shocked. What should happen is we should come at least to the 38.2 or the 50% fib of this big red candle. And if that does not happen, and instead we make another low and we make a substantial low afterward, this would generally be a really, really good buying opportunity. If this happens, if this sort of setup happens on the stock market, on the SPY, any large stock, this is that setup that I just explained. This would be a good buying opportunity into weakness, because that weakness would not be able to sustain itself. I'd be very, very shocked if it did. But currently, we're seeing some weakness out of the 10-year yield. We should see a bit of a bounce soon. That I would be shocked if we don't, to be honest. But it's crazy. Let's see what happens. So this is the 10-year yield. Let's take a look at the 5-year yield. 5-year yield is holding support. Not looking that terrible compared to the 10-year. Let's look at the larger yields. So the larger yields are way worse looking. So this is the 20-year. And then let's take a look at the 30-year. The 30-year is way worse looking. So the longer term yields are looking way worse. So yeah, this is fun, to be honest. So once again, I am assuming that we should get at least a 38.2% fib or a 50% fib bounce of this candle. And the way that you could get that is you just draw the fib level from the top to the bottom of the candle, and you should get a bounce to at least the 38.2 or the 50. I'd be shocked if we don't. But when there's an aggressive amount of buyers in the stock market, when there is an aggressive amount of buyers with the central bank in Japan also buying back bonds and injecting capital into the economy, that sort of messes around with what should be going on with the yields and the dollar and the VIX. So that's because there ends up being more volatility with the bond market and everything like that. But generally, what I'm saying generally should be happening. So if it doesn't, then that is what it is, to be honest. Good for us. All right, so now I want to take a look at two indicators, the NYMO and the NYSI. So the NYMO, when it flips black, that is when there's bullish momentum. So generally when this flips black, it's really, really bullish. We see a lot of buyers. And then when it flips red, it's bearish and we see sellers. So currently, clearly, lots of buyers and very, very aggressive and bullish. We see the green line, which is the 8 exponential moving average, crossed above the 50 exponential moving average, simple moving average. That's generally bullish. And there's still space to cross above the 200 moving average and the 8. So the 8 can still cross above the 200. So there's still room to go to the upside on the NYMO. And what's most interesting is the NYSI. So the NYSI recently crossed above and is starting to curl upwards. So same concept. When it turns black, it is bullish. When it turns red, it's bearish. So we just turned a bit recently here. So there's still a lot more room to go to the upside. We're still extremely oversold on the RSI. There's a lot more room to bounce. And we could just take a look back in history whenever we could just quickly take a look at every time this flipped black on the SPY, what ended up happening. So on August 28th, take a look at the SPY here. What was going on? August 28th right here, this candle, we flipped black and we ended up still moving upwards the next few days after. Let's take a look over here. July 6th. What happened on July 6th? We flipped bullish here on the NYSI, and obviously we skyrocketed afterward from 440 all the way up to 457. Let's take a look at, June 26th, we flipped again over here. June 26th is right here. We flipped right at the bottom. This marked a bottom. We ended up rising from 430 to 445. And then, let's just take a look at the last one here. early June, end of May. So May 31st. May 31st. Again, this marked another huge move to the upside when the NYSI flipped black and became bullish. So you could also see that it's about to cross above the 8 exponential moving average. This could also be really, really bullish for the market. And I'm surprised. This is really, really bullish and very interesting. But there are some bearish things that we need to start taking a look at. And, you know, first and foremost, let's go ahead and take a look at the NASDAQ. All right. So the NASDAQ, it's starting to get close to a level of resistance here. So a downtrend level from back from July's high, we connected that, and now it's getting close to a it's a few points away from a resistance level here. So tomorrow that resistance level would be at 374. The day afterward, so basically it's going to be around the high 373s to 374, and this basically also pretty much coincides perfectly with this 786% fib. So the NASDAQ is getting close to a level, to a downtrend level. Okay. The other thing that I want to show you guys is the large tech stocks that were moving the market are also starting to get a bit over, not all of them, but some of them are starting to get a bit overextended. So what's going to be interesting to see is how sustainable the moves in the other large tech stocks are going to be to help cool down the moves of the bigger ones that are very overextended. So for example, my main concern is Meta. So Meta is starting to really, really skyrocket, and it is comfortably trading, opening and closing outside of the upper level of the Bollinger Band. So with Bollinger Bands, with large stocks, this more so applies when things are trading to the downside. Okay? When things are trading to the downside, an injection of capital will help propel the market way more, and we will get a bounce back inside the Bollinger Bands much easier when it's trading outside the lower level of the Bollinger Bands. When we're trading outside the upper level of the Bollinger Bands, it's not as simple as to just short, okay? Because we're fighting against upward pressure of billions and billions of dollars. So it's not as easy to just short and be like, okay, I'm going to short, we're going to hit inside the Bollinger Bands again. Generally, it works, but just understand that it's not as clean. It doesn't work as easy. It doesn't work as easy as it is when you're trying to go long when the Bollinger Bands are down, okay? So I hope that makes sense. But what I'm concerned about is Meta is clearly overextended now. Meta wasn't one of the biggest movers of the market, but it's a large tech stock. It's getting really, really overextended. So we should see a bit of a pullback on Meta soon. The next stock is Nvidia. Nvidia is getting very close to the upper level of the Bollinger Band. Nvidia was a big reason why we ended up rising here. The AI chip-related stocks, big reason why. So Nvidia is getting close to the upper level of the Bollinger Band. There's still more room to go to the upside, obviously. We could still rise easily, but we're getting close to levels of resistance. So the Bollinger Band here, you can see that it's pointed upwards. So the Bollinger Band can continue pointing upwards, and Nvidia can continue to climb and hug the upper level of the Bollinger Bands without it ever getting really overextended. But it's important to realize that we're getting close to points where it's really, really like you should not be trying to go long up here, in my opinion, on these stocks. We can take a look at AMD. AMD doesn't look too terrible in terms of overextension, but we are seeing a red candle at a level of resistance. Not the best sign. Google, crazy strength out of Google. This is crazy. We held the 140 level. We didn't even come back and retest anything crazy. We just broke above 142, and the upper level of the Bollinger Band on Google is pointing upwards as well. Crazy, just disgusting uptrend level here. And this is, it's tough to start being bullish up here, right? So it would make sense to just wait, to be honest. This is not really a good opportunity to go long on Google. we need to see some sort of a pullback at prior levels of resistance before you want to start going long again. But we're seeing some crazy buyers out of Google here. Let's take a look at Tesla. So Tesla, similar to AMD, red candle at a level of resistance, nothing too alarming. But Apple also showing a lot of strength. You can see the upper level of the Bollinger Band is pointed way upwards here compared, to Nvidia and Google. You can see it much clearer here. There's a lot more room for Apple to run, and for Tesla as well. Oh, sorry, Amazon as well. Amazon was one of the stocks earlier in the a few days ago. I was saying that a lot of love can start going into Amazon because a lot of the move for these other stocks already happened, and money needs to flow into the losers. That's what tends to happen. We were looking at Google, we were looking at Nvidia with a huge abrupt move to the upside, and then I said, okay, Apple and Tesla, we're going to start getting some love. Apple and Tesla started to get some love. Once those started to move, once the AI stocks started to move, I saw Amazon. Amazon was still trading down here. Amazon is also heavily influenced by the IWM and consumer discretionary stocks. So once the IWM started to do well, and once the other stocks already held support and started to do well also, Amazon was meant to bounce. It was like easy money on Amazon. So my point is that the big winners, Nvidia, Google, they're starting in Meta, they're starting to get overextended to the upside, especially Meta. So we forgot to look at Netflix. Netflix made new lows, and yeah, that's another reason why I hope Netflix goes bankrupt. But regardless, my point is that it's starting to get close to levels of resistance. It's not the best time to start going long, and you have to start being wary. Okay, now let's go ahead and take a look at the IWM. Okay, so this is a daily chart of the IWM. You could see that we're breaking out of a falling wedge. Very, very bullish pattern. Sure, that's completely fine. We're back to this level of resistance here at 176 and 177 area, coinciding perfectly with the 20 exponential moving average. But what I want to look at here is the 50 SMA is looking to cross below this purple line, which is the 200 simple moving average. And when that happens, that is generally known as the death cross. The death cross is generally supposed to be bearish, but at the moment, recently, when we did have this death cross on the IWM, it wasn't extremely bearish because we've been in a choppy environment. But generally, you guys understand that when there's a golden cross is when the 50 moving average crosses above the 200. We're pragmatically a few days away from a death cross, and that is something to take note of. And yeah, it's going to be interesting to see how many buyers can come and keep this market up. 177, 178 is a major level of resistance on the IWM. And 174, 175 is a major level of support. So those are the two levels. We have to see which one holds and which one breaks, in my opinion, on the IWM. Last but not least, let's take a look at the S&P 500. All right, so this is the daily chart of the S&P 500. I was showing how it was very close to a level of resistance as well. Granted, the NYSI flipped bullish, but we're getting close to a level of resistance. And yeah, we could have some more room to the upside, but this 437 level is very, 437.72 level, very, very important. This dates back all the way to July of 2021. And you can see this level was clear cut, very, very important level of resistance and support multiple times. Multiple times back in July here, multiple times it acted as support over here. Like it broke below here. This acted as resistance and support, etc. Like this was a very, very important level of resistance and support. And then all throughout 2022 as well. Super, super important level. So now we are back, and we are potentially days away from touching that level again. So we need to see how we respond. So once again, yesterday's high wicked very close to that level, and today we were unable to break and hold above basically the high. So we need to see if, you know, we need to see how we respond here at this 437.70 level. So that's going to be the most important thing. So the SPY is close to a level of resistance. The large tech stocks are starting to get a little overextended. There's a lot more room on Apple, Amazon. There's a lot more room on those stocks, but we're getting close to levels of resistance. I am not starting to become, this is not the time, regardless of what happens. Now is not the time to start adding longs. Whether you like it or not, now is not the time to start adding longs, nor is it really the time to start adding shorts. So I would be, if you do add short, you have to give it some time, and you have to just be very, very careful with your position sizes. You could take some stabs, you could take some short stabs, you know, $100, $200 contracts, nice little small throwaway gambles, but I would be very, very careful, because this is still showing a lot of bullish pressure. We see the NYSI showing a lot of bullishness, and seasonality in general for October, November is supposed to be very, very bullish. So we have seasonality on our side as well. Once this second week of October is gone, the third and fourth week is supposed to be bullish. So there's seasonality on the bull side as well. I'd be very, very wary to try to short. Instead, if we make a high above, I would rather look to short on another leg higher, closer to 440. And then once we have, because if this continues up and we never get a bit of a pullback, where today we technically did get a pullback, you know, but no like red candle sell-off sort of pullback. So if we end up breaking above, back up to like 440, 441-ish area, that would be a better opportunity to short. Nothing here is really a good opportunity to short. So currently there's a lot of bullishness, but there are some bearish things to take a look at. So that we did take a look at. So, you know, I hope I did a good job explaining the overall market for you guys. I hope you guys enjoyed today's video. Please make sure to like, comment, subscribe, do all that good stuff. And I will see you guys bright and early tomorrow morning. Thank you.